Hi, and welcome to the Trading Pit, personal investing and trading tools for the active trader and investor. I'm Lundy Hill. You could say I'm a lifelong commodity futures veteran. Having grown up in a prominent trading family, I made my first futures trade in the 1970s before I could even drive. I kept hand charts for my father, John R. Hill. He's a famous trader, author, and speaker, and the originator of the opening range breakout. He was the original opening range breakout trader, which you've heard a lot about. I've had just about every job in the futures industry, from runner and local trader on the floor of the exchanges to the top floor of the trading office as a broker and commodity futures advisor, commodity trading advisor. Here are the charts that caught my attention this week. First, this is not investment advice. I am not a financial advisor, and past performance is not necessarily indicative of future results. This is a weekly update for the week ending April 25th, 2025, and on to the charts. The NASDAQ, and by extension the stock market as a whole, may have found its bottom 2 weeks ago with that exhaustion gap down open. That gap down open reached almost exactly to the extended 2+ rally, the 2+ years rally. It extended almost exactly to the 50% retracement level of that 2-year rally. And this week formed a bullish engulfing bar. And it also had a strong close, which formed a foreclosed reversal bottoming pattern, which is one of my 9 patterns which signal a trend change. However, this was not echoed in the S&P nor the Dow, so only partially triggered on the NASDAQ, but not so for the other markets. Here's a close-up of that action. We see the foreclosed reversal pattern and also a weekly bullish engulfing pattern. Any long position would assume a lot of risk here, as the stop loss would need to be below this past week's low, around 2,000 points lower. Also of note is the uneven wave formation. We've got an equal wave 1 to 2, and we've got that forming the ABC down pattern, and we see this latest wave down was deeper than the prior wave down. That tells me that there is more selling coming in now on that second wave down than the original first wave down. So we will probably see another leg down, at least to test the lows around 17,000, maybe 17,500. But enough of stock indices. Let's switch to traditional commodities, starting with soybeans. Soybean futures also are working off a bullish engulfing bar from 2 weeks ago. This came after a test and a failure of the 7-month lows around $9.50. Prices quickly sprung back up off those lows up to the highs of the past 7 months, not quite reaching the highs. If the prices can break and close on a weekly basis above that 1075 area, I think beans could run here. Next, let's look at coffee. Coffee just had its second highest weekly close ever at around $4. In February of this year, it had a weekly close of 407.40. That was the highest close that I could find. So, is coffee ready to make another move? Look at this wave we've had from, well, let's go to this chart. We see a move from $1.42 all the way up to $4.30. And we have currently closed a wide range bar up. This is a rally of 200% from the lows. Also note that coffee over that entire rally had very minimal reactions in that time frame. The current pullback is the largest one we've had yet, and it's the only one that has an ABC pattern. Most of them are just one leg down and then the resumption of the trend, which leads a lot of strength to that trend. Here's another chart of coffee. Note the spike low 2 weeks ago, 3 weeks ago, almost reached down to the Fibonacci 38.2% retracement level of that entire 18-month rally. This bodes well, I believe, for new all-time highs coming up in coffee above those highs earlier this year. An equal wave projection puts coffee over $6 a pound. Next, let's go back to sugar from an earlier chart. Sugar futures have had some nice tails down around these multi-month lows and a spring off the 12-month lows around 18 cents. This was the third time breaking below these levels this year, and they didn't hold. So I think the low-risk trade here, in my opinion, is a long position for a move back up to and possibly a breakout of the downtrend line, which I've highlighted here, coming in currently around 20. Conversely, a move back down below that 18 could signal much lower prices to come. Next, on to cocoa. We all know cocoa's had a dramatic move in 2023 and 2024. Finally, cocoa I believe, is ready to resume that spectacular up move. Cocoa has been trading in a well-defined, albeit wide, upsloping channel for the past 12 months. We just had a wide range, high close weekly bar, which reversed the previous 9 closes. This, I believe, is very strong. A move back to the top of the channel around 1400, I believe, is warranted. That's a 50% rally from these current levels. And much less if we get another rally like we had in cocoa in 2023 and 2024. So soybeans, coffee, sugar, and cocoa are all signaling possible higher prices and possible food inflation. Not to mention strong action in corn and cocoa, which I did not cover here. However, crude oil, which has input functions in all commodities, is playing around 3+ years lows, having cut its price in half since 2022 highs. So it's gone from about $130 a barrel all the way down to about $65 a barrel. Is this deflationary? I tell you this, I think crude oil under $70 a barrel is not inflationary. Several market technicians I follow are bringing up deflation for the first time in a long time. Not inflation, but a deflation. They're predicting a deflationary depression as people stop buying. What you have to consider is the game of chess, not checkers. Fed and the economy dislike deflation more than they dislike inflation. If you have deflationary prices, why buy anything now when you know next year the prices are going to be even lower? So what you have to consider is the policy response to a deflationary episode. And that would be massive money printing and possible negative interest rates. Not just negative real interest rates, but negative nominal interest rates, which would be unheard of. And let's not forget gold. Gold has rallied dramatically, as everybody knows. And let's look at the gold to crude oil ratio. It has skyrocketed from under 24 to over 34 in just 34 weeks, about 3/4 of a year. This tells me that gold's rally is something deeper than an inflation scare, that we possibly do have a deflationary crisis coming. But gold, I think, is telling me of a possible banking scare. After all, the biggest buyers of gold lately have been what I call the bankers' bankers, the central banks. What do they know that they are out there buying tons and tons of gold, literally tons and tons of gold? I hope you enjoyed this. Please leave a comment. Let me know your thoughts on this. And if you liked it, please like and subscribe. Thank you so much.